All right, so today is the third lecture, and today we'll be covering more broad kind of like risk concepts. We introduce a few kind of formulas. We'll talk a little on theoretical kind of, we call this the efficient market hypothesis. So we'll talk a little about that. And I guess if you didn't really like too much of the calculation in the last lecture, this one will be better because there's a lot lesser calculations. Last lecture was like really heavy on calculations. We will not really talk so much about time value of money today. So that will be lecture 4. So today we'll do like a side track a little to talk about risks and returns, and we'll come back to time value of money again next lecture, in lecture 4. All right. So before we start, because there was a pre-recorded lecture, I just want to check if everyone's okay with the pre-recording. Were there any parts that were unclear that you wanted to clarify? So maybe I'll just see if there's anyone that requires any clarification. We can jump back to the examples. Right. So as usual, if you do have questions regarding the pre-recorded lecture, feel free to just drop me an email. We reply quite quickly. Like in the last 2 lectures, we'll do 2 breaks as usual. I think that's quite good, and so that you can just rest a little, because sometimes the content can be quite heavy. All right. Okay, so let's just start with today's lecture. So I mentioned today we'll think a lot about the idea of risk and returns. And the thing is, if you're a finance student, or maybe not finance, but if you're like a general management or business student, right? The idea that risk and returns are almost opposite side of the same coin is very important, right? So when we think about an investment, we cannot just focus on, let's say, oh, it gives me 50% return, which is a lot, or 10% return, which is quite little, or actually it's quite a lot nowadays. So we cannot just think of the returns component. We need to understand the risk component, which is, let's say if you ask like a science student, right? A science student or maybe an arts major, they might know about, stock returns and all, but most of the time we focus simply on the returns rather than the risk. So as a business student, the important differentiation between you and, let's say, another science student or art student is that when you talk about returns, you should also talk about risk. So that's like the broad kind of understanding. And the general concept is that you are only rewarded in terms of returns if you take on certain type of risk. So the type of risk is important, and taking like this random type of risk need not necessarily give you returns. So that's an important part, right? So we need to consider what type of risk we are taking, and only certain type of risk give us returns, right? But the idea is that the more risk you take, you should get more returns, right? Because you should be compensated for the amount of risk that you are taking. So basically, I guess the market is quite fair. It's like if you take more risk, we'll compensate you with more returns. But the thing is, there are certain type of risks that if you take, you will not be compensated. So that's the general concept. So, as usual, like in most, in the last 2 lectures, if you do have any doubts, of course, the lecture is the best avenue to clarify them. Feel free to just type the chat or even unmute yourself, right? If the question is a little bit long. All right, so let's think about the returns component first. Relatively more easier to understand because we have always seen returns. We have 2 kinds of returns here. So we have returns in terms of dollar return, right? So dollar return means like the amount of money, and they are, let me just pull out the pen, and they are broken down into either the dividends component or the capital component, right? Capital gains or dividends. So in the classic example of a stock, you have capital gains, and of course you get dividends as well every, let's say, semi-annual or every year. So those are the returns. And in terms of capital gain, we know that it should be the amount that you initially paid, or maybe the final amount minus the amount that you initially paid. So how much gains you get. This idea of percentage return is important, is that we need to calculate what percentage of your investment, or more specifically, what is the return based on the percentage of invest or the money that you invested. So there are a few ways where you can calculate percentage return. Okay, so let's look at dividend yield first. So dividend yield basically means that, what is the dividend that you get, which is here, divided by the initial price of the stock that you buy, which is PT. Right? Capital gain, it's what is the price in T+1, maybe in year 2, versus the price in year 1 here, right? Divide that price in year 1. So I guess this is like a bit of a basic kind of arithmetic kind of way to calculate gains. Now, in terms of total gains, we need to consider both the capital dividends and capital gain, which is given by here. I want to highlight something here, right? That whenever we do calculations, most of the time we use percentage return. All right, so I'll put a star here. Why? Because there are certain questions, right, that can be very tricky, that they give you stock price. So they give you stock price, let's say 2021, 2022, maybe even 2023. And then they tell you a price is like $1, 1.2, 1.3. All right. So these are stock prices. So when you see stock prices, right, we always will have to convert it into returns. In terms of, this is a capital gain kind of return, right? So we have to calculate returns. So just be very careful, especially, let's say in your exam, that when you read the question, if it's read carefully whether it's a stock price, whether information given is a stock price or returns. So we'll have one example later to illustrate how or why you need to calculate percentage returns and we cannot use stock price. All right. Everyone is clear between stock price and returns. So those two are different things. So stock price is the actual price on the market. Now returns is where we calculate the difference, right? The difference, and in terms of either capital gain, the total returns giving capital gain and dividends, and if it's just capital gain, then it's just the increase in stock price. So this is important. Maybe I'll just put a star here, right? Okay, so now this is just a short example. So you've invested in a stock with a share price of 25. So this is the initial share price. After 1 year, the share price increased to this. For each share pays a $2 dividend. So what's the total return? So when you think of total, we have both the dividend and the capital gain. So in terms of dividend, we have this amount. In terms of capital gain, we know that we increased by $10. All right. And so the total returns in terms of dollars, we just add 2 plus 10 percentage is shown here. So I'll just move a bit quickly for the initial part, and then we can spend more time on the tougher components, right? Okay, so let's just move on from here. So these graphs are, we just use the this portion here. Okay, so what's important here, right, is that, do you notice which is the most risky asset based on what is in here? Which is the most risky in your opinion? As usual, okay, let's type in the group chat. Which one do you think is the most risky investment? most risky. So, okay, so inflation is not really an investment. You can't really invest in inflation, but that's thanks for the answer. Yeah, so I see most people saying small stocks. That's true. So maybe I'll explain why. So remember I mentioned at the start of today's class is that the more risk you take, the more returns you get. And I specifically say, oh, there's certain kind of risk, but let's just put that type of risk in our back of mind first, because we'll talk about it later. But generally, the more risk you take, the more returns, right? So simply by looking at the returns, because these are average returns, we see that the small stocks gave you the highest returns, right? 16.5% returns, which is the highest. So it means that if you are purchasing the small stocks, you're actually taking on the highest amount of risk. And this highest amount of certain kind of risk, right? So followed by the large stocks. So in terms of the type of investment, do you notice that stocks are generally the riskiest, followed but government bonds or bonds in general are less risky, and treasury bill are the least risky. So in terms of the type of investment, stocks are the most risky, bonds are all right, and treasury bills are the least risky. So that's the different like risk category for the types of investment. But within the types, the small stocks are the most risky. So what are small stocks? Small stocks basically are like SME companies that are listed. So, or maybe not even SME, it can be startup companies that are being listed. So basically they do not meet a certain valuation threshold. And so they're considered small. So they're called small stocks company. All right. So those companies, you know, if you think about it like, oh, if it's a startup, then chances of them, you know, becoming bankrupt or failing is much higher, right? So that's why there's higher returns, and therefore higher risk, right? So the returns are to compensate the risk that you're taking. One more important thing to take note is that if you notice, treasury bill and inflation are very close in terms of the average returns. And that is because generally the treasury bill is being tagged to inflation. So the thing about treasury bill is that it kind of moves with inflation. So they are very close to each other. All right. And generally treasury bills are considered risk-free. Right. So I'll put this thing called RF here. It's called risk-free. Generally, they're considered risk-free. And therefore, the returns that you get on the treasury bill actually just simply shows the inflation, right? Even though they are slightly different, but they're actually quite close. So RF is risk-free, right? Okay, so if we want to do a simple kind of arithmetic returns calculation, we generally just take as most mean or averages. We just take the total number of returns divided by the number of period t here. So this is the most basic kind of form of calculating returns. All right, which I guess you have learned in most in like, let's say, primary school or even secondary school. And so, for example, if you have returns on all these, so hopefully you can see, let's say all these are returns, right? So you just add up everything divided by the number of years. That's how you get the returns. Now, in terms of, remember earlier we mentioned that the treasury bills are risk-free. So the idea of risk-free is that you are actually taking on no risk, meaning that this bill will not ever default, or the cost. Okay, so treasury bills are from the government, right? So in theory, the government shouldn't default on payments of this bill. That's why it's considered risk-free. Of course, you know, if you are following the news, I mean, back in 2018 or even in certain economies now, we know that governments can actually default on their payment, right? When the government actually goes bankrupt, and there are a few countries that are actually experiencing this quite badly. Not sure if you all know, like Lebanon. So Lebanon economy is actually in free fall. Governments are unable to pay because they have not enough investments into their country, right? So generally, most of the time we consider treasury bills, especially the US treasury bills, as risk-free. But nowadays there's a bit of risk in these bills. All right, so once we understand the idea of risk-free, anything that is above the returns of a treasury bill becomes the risk premium that we are taking on, right? So because of the additional risk we are taking on, that's why we get additional returns. So let me just jump back to this slide here. So imagine, so we know that treasury bill is 3.6, right? This return here. So in terms of risk premium, if we look at the small stock, which is the most risky, so if we take 16.5 minus 3 point here, so 16.5 minus 3.6. So this is kind of like the risk premium that we are paying, right? That is on top of the risk-free returns that we're getting simply by taking the treasury bill. So this is the additional risk that we are taking in this sense. Any questions here about this? All right, hope it's clear. So basically, they are the excess returns on a risky asset over the risk-free rate. So this is important, right? So in questions, how they can actually say is that they might just mention the treasury bill return is, let's say, 3.6%. So when they say treasury bill return, you need to immediately know that it's this thing called risk-free rate. So the risk RF, right? So treasury bill equals to risk-free. So sometimes questions can be a bit tricky. They don't say the risk-free rate is this amount. They say the treasury bill rate. So you need to know the term treasury bill. All right. Oh yeah. So basically, what is being shown here is the numbers that we saw earlier, and these are basically the risk premium amount. Of course, the treasury bill is risk-free, so by definition, there is no risk premium. All right, so we have looked at the returns component, and in terms of returns, we saw a few ways to calculate, and the most basic is just the simple average. We just take the total returns, divide by the number of period. Now let's look at the risk, in terms of risk, right? So in terms of risk, whenever we try to think about risk, we need to think about the idea of volatility. So how volatile is it? And when we think about volatility, is positive volatility and negative volatility. What does this mean? It means that, okay, if you look at this, hopefully you can still remember the normal distribution, right? We can see that sometimes maybe the stock will give you very good, this is positive number, right? Here's 0, there's negative. Sometimes it will give you very good value, right? Or very good returns, positive. Sometimes it will give you negative. So if you have very extreme values, very good and very bad, right? Very positive and very negative, naturally it means that there is volatility, and therefore it's very risky, right? So even though your stock might give you very good returns, but if there are times that the stock might fall into this component, this portion here, then it's actually a very risky stock because it can give you the extreme. Of course, if the returns are mostly in the 0 mark or like congregated here, maybe it's considered less risky, right? So the dispersion or the volatility is lesser. So the classic example or the classic measure of risk is this thing called variance. So how dispersed your returns are. And I want to highlight here that the variance gives you the total risk. So remember, I told you that risk, there are various components of risk. So we'll be tackling the various components, but if the question or if somebody say total risk, remember it's always the variance and hence you need to calculate the standard deviation. Anyone knows why do we need to calculate standard deviation? Why not just use the variance number to compare things? Anyone knows why? Why do we need to calculate standard deviation and not just use variance, right? Variance, say, is a common measure of dispersion. So why do we bother to calculate standard deviation here? So maybe I'm not too sure. The answer is kind of in the slides in the sense that here, what's mentioned here is the same unit. So basically what it means is that, in variance is sigma square. Later we will see how to calculate it, the formula to calculate it. But the idea is that it's sigma square, meaning what? When the units you calculate out, right, it will be percent, because remember we're calculating returns, right? What is the variability of the returns? Returns, I mentioned earlier, was in percentage. So what happens is that for variance, the units will be percentage square. And naturally, if you think about it, what does 5% square means compared to 2.5% square? Does it mean half the amount? No, right? Because it's square. So it becomes very difficult to compare things with a percentage square, which is why we do this thing called standard deviation, where we just square root the variance, right? Sigma square is the variance. So you square root the sigma square, which gives you sigma. So the main thing is about the comparability issue. So 5% square doesn't mean it's 2 times that of 2.5% square, because it's a square, right? So that's why we use standard deviation here. And standard deviation measures total risk, right? I'll put 2 stars here because the idea of measuring total risk will be very important, and we need to know that standard deviation is total risk. Later, we will go into details on breaking down on the type of risk, but in terms of total, it's always the standard deviation of the returns. So the formula for this is simply you just take what is the return for that year, that month, minus away the average return, and then we square it, right? And then so you square it and then you sum it, right? So you add all these squared values. So we have example later to have a look. So don't worry. And then the thing is, we need to take t minus 1. Anyone knows why we do t minus 1 here? Can recall your, I think probably in secondary school, your teacher might have mentioned this, because I think variance and standard deviation is part of your O-level syllabus, right? Anyone remember why must t minus 1? Should it be t minus 2 or t minus 3? Or should it just be t, right? Maybe you don't even need minus 1. Anyone knows why? No? Yes? Or you want to give it a try? Why is it t minus 1? So maybe you're not too sure, but the idea of t minus 1 is that there's this thing called df, which is degree of freedom. So what does this mean? It means that the degree of freedom is this example here. Okay, let me just give you an example. So this is just for general knowledge for you to understand why t minus 1. Let's say we have 4 objects, right? 4 balls. Let's say we have 4 balls, and the balls are numbered. So in terms of the balls, let's say, okay, let me just not draw the ball. There are let's say 4 numbers, right? So if we have 1, let's say 4, 8, and 2, right? And then we have this number, these 4 numbers here, and we are given that the mean, right? The mean. So the mean is in this sense is 15 divided by 4. So we know that we are given 15 divided by 4, right? As the average, right? The simple average. So if we are already given this average, and if we are just given 3 numbers here, can we actually deduce that the 4th number in this set is 2? So we can deduce these 2, right? So if we are given a mean and we are given 3 numbers, we can deduce the 4th number in this set of numbers. So in the same sense, right, what's happening here is that we do not actually need the 4th number to determine values. And in this example here of the var, right, the var, we are already calculating the mean returns. So in this sense, right, we do not actually need the last number of the set of data. And therefore, we need to do a -1 here. That's why we need to remove 1 degree of freedom from the calculation. So in Excel, just be very careful. You can always use Excel to just drag and compute the standard deviation. Just be very careful that you should be using the standard deviation .s. All right, so .s version of the formula. If not, you'll be using the population standard deviation, which is the wrong one, because this is the sample standard deviation. That's what we are interested in calculating. We'll see a few, I think 1 example later. All right, and then we can calculate a standard deviation, which is just the square root of the variance. Okay, so at this point in time, I highlighted this again, that the details here are given in terms of return. So this is a very typical kind of question. So they give you the returns, then you need to calculate what's the average return. Average return meaning that we sum all these returns, all right, then divided by 1, 2, 3, 4, 5, divided by 5 years to get this. And then in order to calculate standard deviation, we simply just take returns, right, returns minus average. So it's number 4, and then we square it, right? And then we can get the variance and then get standard deviation. So this is like the manual method to calculate, but let's say, right, of course, you can all use Excel. So let's say if you are just given the returns figure. So let's say you are just given this 1, 2, 3, 4, 5, 6. Sorry, 5 numbers. If you are just given these 5 numbers, you simply just use the standard deviation formula or even the variance formula in Excel, but just use the variance.s formula and you can get answer. So you don't even need to show all these calculations, right? And like this, what this say is that if the question gives you stock price, you need to calculate returns, right? And how we calculate the returns is the this year's stock price minus last year's stock price divided by last year's stock price, which is basically the capital gain percentage. So let's look at now the standard deviation. So can we see a very nice in terms of like association or correlation between standard deviation and mean, right? So if you notice, when the standard deviation is higher, remember standard deviation measures total risk. When the total risk is higher, the mean returns are higher, right? So there's a nice kind of relationship, and this is exactly what we see here. So higher standard deviation means higher total risk. Higher total risk means higher mean returns. So that's the relationship. So generally, is it? Let's see. Yeah, that's right. So yes, it is the same as high risk, high returns, but later we'll look at what type of risk. So not always high risk, high returns. So yes, now we are just kind of like explaining the general concept, but later we'll go even deeper. We'll say like, okay, what kind of risk would give you higher returns? So if you take on unnecessary risk, let's put it unnecessary risk. If you take on unnecessary risk, it will not give you higher returns. So yeah, you're right. At the moment, our understanding is high risk, high returns. That's right. Okay, in terms of the variability or the standard deviation, naturally we always assume a symmetrical kind of distribution, like a bell curve. So it's like the normal distribution that we saw earlier, like this, right? Which is described by, as you know, a normal distribution, and is usually described by either the mean and the variance, right? Normal distribution. So just for information, normally we assume a normal distribution for most assets, but this might not be the case. For example, during an economic, let's say, turmoil, which is kind of like actually now, the markets are quite erratic. They do not know how to react. We know that there was a big acquisition of a Swiss bank recently, right? So because of like market turmoils, things might not, or the returns might not be reflective of a normal distribution. So the idea that a normal distribution is appropriate is only a point of time where the markets are quite smooth sailing, or they are like normal days, right? But once there is some disruption in the market, there is some turmoil, then it might not be a normal distribution anymore. So these are examples of the 2008 financial crisis, where actually at the end of the day, we cannot use a normal distribution to model our standard deviation, right? And so, if you are interested in finance and go on to take on more advanced finance course in the school, we will learn about various other kind of distributions that we can use, right? But I'll not cover that here. Okay, so remember earlier we talked about the idea of a simple average, and simple average means that you just add the numbers that say 4, 5, 6 plus 7 divided by 4, right? 4 numbers. So this is just the arithmetic average or arithmetic mean. Now, in finance, most of the time, in the industry, I would say 100% of the time, people use this thing called the geometric average. All right. So the idea of a geometric average kind of brings in the idea of compounded returns per period. And remember last lecture, we already talked about how we cannot use simple, when we calculate interest, we can use simple interest, right? We have always use compounded interest. That's why we learn time value of money and everything, right? Because of the compounding can actually drive up the, let's say, if it's an interest, we can get a lot of interest, right? If we compound it for, let's say, 100 years. I think we look at example of the Manhattan Island last lecture. So in this same sense, because we are studying finance and all, we need to consider compounding. So in this sense, we need to use geometric average most of the time, right? And so the idea is that geometric will be always lesser than the simple average unless all returns are equal. So this is just one of the interesting properties of a geometric average. So we'll have a look at how we calculate geometric averages here. So how we calculate geometric average is relatively straightforward in a sense. We just put 1 plus the returns. So the returns can be, let's say, is I don't know, 0.3. So there's 1 plus 0.3 times right? 1 plus, let's say the next return is 0.4, etc., right? And then we need to make sure that we not really square root it, but like put it to the power of 1 over t, then we minus 1 here. So don't worry, there's an example in the next slide to explain this. So this is just another form of writing a geometric average. This means product sum. So product sum, meaning that we need to do the product first, multiplication, then we do the addition. So product sum. So it looks scary, but it is exactly what we saw in the last slide. Okay, so this is the example of I like to use to explain geometric averages and arithmetic averages. Now, before we look at this calculation here, all right, let's look at the stock price. So just focus on here first, okay? Year 1, year 2, year 3. So year 1, we have the stock price of $1. Year 2, the stock price of $2. And year 3, the stock price was $1. Okay, so without even calculating the averages or whatever, right? Based on just looking at these three numbers, do you think that you actually make money after at year 3? Do you make any money? No. Okay. Right. So when you say no, this makes total sense, right? It's very intuitive. Yes, of course you make no money, right? Year 1 you have $1, year 3 you have $1. You make no money. Okay, but let's calculate the returns first, right? So we know that from year 1 to year 2, we have gained 100% returns. Now, from year 2 to year 3, what happens? The amount of money decreased by 50%, right? So the returns decrease by 50%. Remember how to calculate returns? Returns is the second year, so $1 minus $2 divided by $2, right? So that's how we get 50% here. And the 100% is $2 minus $1 divided by $1. That's how we get 100%. So after calculating the returns, if we are supposed to use the simple average or simple arithmetic average, what do? We just take the returns. Remember the last slide, we just take the returns, 100% plus negative 50, which is here, divided by 2. And your arithmetic return say that, hey, you know what? You gain 25%. But you know that's not true, right? You guys all say that, no, if my stock price was $1 in year 1 and my stock price is $1 in year 3, I did not gain anything, right? So this is why in finance or in the market, no one uses arithmetic mean because it doesn't make sense. Now, if we think about the idea of compounding and use the geometric return, this will make a lot of sense really. So in the same idea, I'm just going to flip back to the formula here. So the formula is this, right? Product sum. So if we do product sum, it's just 1 plus the returns. All right. So 1 plus the returns times 1 minus that 50% that because you less your return was negative to the power of 2, right? Because you have 2 periods minus 1. So what happens now? You notice that your geometric returns is negative. So your geometric return is 0. So it means that, hey, AJ is correct, right? It makes sense to you because intuitively just now you say that you did not make any money. And so geometric mean or geometric mean returns say that, yeah, that's right, you did not make any money. So the geometric return is the correct method to use here. And if you notice, your geometric returns is always lesser than your arithmetic. Remember, that's one of the properties we mentioned, that the geometric is always lesser than arithmetic. So it is exactly shown here. I want to highlight something else as well, that it is important to note that you notice there are 3 years here. We are considering, let me just use this color. So we are considering year 1, year 2, So year 1, year 2, and year 3, right? But in terms of the number of returns we have, we only have 2 returns, right? Because we need 3 numbers to calculate 2 returns. And therefore, if a question gives you stock price, when you calculate geometric return, we only use 2 because we have lesser number of returns, because it's less, because we have 3 stock price, we have 2 returns, and therefore your geometric return formula only has 2 numbers, right? And because you have 2 numbers, that's why when you put it to the power, it is to the power of 1/2. Okay, I hope everyone understands this, because these are like the small things that sometimes if you don't think about it carefully, you just simply put, oh, you know what, there are 3 years, so I should use 3, right? 1/3. But no, you need to look at number of returns, and so because there are 2 returns here, so it's 1/2. So this is an example of a geometric return, geometric average return, but this time there are multiple years. And the good thing is that they have already given it to you in percentage return. So we just do 1 plus this amount, right? 1 plus, and then we just need to do the compounded, where we just multiply these, this with this, this with this, this with this, this with this, and then we get this one, and we should be able, well, if we put it to the power of 1/5, we will get the answer. Now, what is interesting is that because we are using the idea of compounding, what we can do is that we can use time value of money to calculate this as well. And how do we do it? So imagine if the question says that, you know what, at the start, our present value is this, right? PV equals, let's say, in this sense, the return, of course, is 1, right? Because we have no returns at the moment. It's just 1. Now, if the question do not give you this big chunk of information here, and only give you this number here, 1.4870, all right? If the thing only give you this, you know that this is the final value after 5 years. So n is 5. Hopefully now you are quite familiar how we do it. So n is 5. FV, we know that they give you the question, only give you this, so it's 1.4870. We know that there's no payment because we are just calculating the geometric average. We can actually calculate the geometric average like this, and it gives you 8.26, which is exactly the same as if we use the formula given in the question, right? So why is the second method important is that there are questions that can be very tricky in a sense that they just tell you the question something like, oh, we have an investment. An investment was invested for 5 years, and at the end of the 5 years, the compounded return is 1.4870. Okay, like in this question here. Calculate what is the geometric return. So if the question just say like this, they didn't give you all this information here, right? They didn't give you all this. You should still be able to calculate geometric return, right? Because of the idea of time value of money, and we can use this method to calculate. Any questions so far? Okay. So if we know that geometric return is always less than arithmetic return, the arithmetic return is kind of over optimistic. Geometric return can be overly pessimistic over a short horizon. All right. So depending on the period that we use, whether it's 15, 20, 20, 40, 40 and above, we can use various mean calculation. So this is just a very theoretical estimation of when you should use arithmetic and when you should use geometric. But I want to highlight to you that in practice, regardless of the number of years, whether it's 15 to 20, everyone just uses geometric. No one uses arithmetic. All right. I just want to highlight, even though the textbook, right, this is more like theoretical, right? But in practice, no one uses arithmetic, because just now we already saw the example, right? It doesn't make sense. If it's like $1, $2, $1, your arithmetic doesn't make sense, right? Okay, so that was more on the returns and risk component that we talk about. Now, we'll go a bit into the theory of this concept called efficient market hypothesis. And I want to highlight this is important to understand, because it is the foundation to a lot of the formulas that we'll look at later in the lecture. All right. So what does efficient market hypothesis mean? So as the classic fashion that I like to do it, I would like to tell you what is the broad intuition first, right? Before we go to all the nitty-gritty details. So the broad intuition of efficient market hypothesis is that as an investor, you should not be able to get excess return on your investment, right? So the idea of excess return is the same as abnormal return. Basically, is return that is above and beyond what is the norm, right? So the idea of efficient market hypothesis, I repeat, is that you should not be able to get excess return beyond what is stated as normal, right? So that's just the broad idea. So once we know that, let's go into the details, right? So how does this efficient market hypothesis kind of predict or suggest that you actually can get abnormal return? So let's look at it. So basically, the hypothesis says that, okay, you cannot get a normal return and you should only get the normal market return. All right. And why? It's because the stock price are generally at equilibrium. So there's this idea of equilibrium where the prices will not go super high or will not go super low, right? So that you can get like additional returns. The information is very efficient, meaning that the information flows in the market very efficiently. So immediately, whatever information that's available will be taken into account by the market. And stock is fairly priced, so there's no mispricing stock. I want to highlight that this is a theory. So efficient market hypothesis is a theory, and it has actually been proven that in real life, we are not an efficient market. So meaning that, what does it mean? We are not efficient, meaning that the stock price are not in equilibrium, the stock is unfairly priced, and information is inefficient. All right, so in real life, it is not really an efficient market. Okay, so what does this mean? If it is an efficient market, okay, so let's look at efficient market first, okay? If it's an efficient market, what happens? So imagine there is some news that is being introduced in the market, right? So at time zero here, there is some good news that's been introduced. So if the market is efficient, what happens is that if it's a good news, the stock price is supposed to immediately, like that, jump up and remain stable, right? Because it's a good news, right? So the stock price like increase. Now, the problem is that we know in real life, the price of a stock doesn't like just shoot up like and just go straight, right? We know that the price of a stock usually has a bit of adjustment, whether it's increasing slowly or increase too much and then it reduce, right? So because of that, it kind of actually proves that the market is not really efficient in the first place. So let's say if the price of the stock go up slowly like this, it's called a delayed reaction. So there's an explanation of delayed reaction here. It means that the market takes a while to understand the good news, and therefore the price slowly increase. So this is a delayed reaction. Now, the market can be too excited as well. So it's an overreaction. meaning that the market thought that, you know what, the information is super good, but actually it's just good, right? Yes, the price will increase, but it's just good. So that's why when initially the market thinks that the news is super good, it will increase a lot. But at the end of the day, they're like, oh no, actually it's just normal. So it will reduce back to correct price. So this new price here of 180 is therefore like the equilibrium, right? That we talk about. The price are equilibrium. So generally, we know that the market is a kind of actually inefficient from this example here. Okay, so now let's think about the type of efficiency. So we are still under the efficient market hypothesis. There are three types of market efficiency that we need to understand. So there is this either called the strong form, the semi-strong, and the weak form. All right. So what does this all mean? It seems quite strange, right? So the strong form market efficiency means that, okay, I'm just going to the next slide. So this is just an overview. The strong form means that the price of a stock reflects all the information available in the market. All meaning what? It means that it reflects both the public information and private information. So this is important, that it reflects private information in the market. So if an investor wants to make like excess return or abnormal return that we mentioned earlier, is impossible, because the market has incorporated or included all information, whether is it in private, your own private information, they have already included it. And so what does this mean? It means that if for investor, you cannot make excess return, therefore, what should you do? You should just buy and hold a diversified portfolio. So what does this diversified portfolio mean? It means that it is a portfolio of stocks that simply is you just hold a big portfolio of stocks. So we'll think about diversification later after the break. But basically, you just hold like S&P 500, meaning that you just hold a portfolio of like 500 stocks, and that's all. Because we know that you cannot beat the market, right? So there's a strong form. So the strong form also includes that includes private information, right? So sometimes you know that private information can be so-called insider information, and it can be illegal, right? But the thing is, we also know that the market is not a strong form, because in real life, let's say if you are an insider to a company, like let's say you are insider to Keppel Keppel, you might have some information that the market doesn't know, right? Maybe the Keppel is going to do an acquisition, and this acquisition will increase the value, the stock price of Keppel. Of course, the market doesn't know that. So because you have private information, we know that the strong form efficiency is not really the real life scenario. So what happens now? We know that the market doesn't include only private information. So maybe the market is kind of like a semi-strong. So what does semi-strong? It means that the market only reflects publicly available information. So in the example of, like, let's say just now Keppel, if we have private information about acquisition, the market doesn't know that, right? And therefore, you know what, maybe the market is a semi-strong form of efficiency. It means that as an investor, you cannot earn abnormal return simply by using public information. What you need to have is private information in order to earn earn returns. And when we think about public information, it is the trading information, the annual report information, press release, anything that is publicly available. It implies also that fundamental analysis will not lead to abnormal return. So what does fundamental analysis mean? Anyone have heard of this? Fundamental analysis. Have anyone heard what is fundamental? No? Okay, so all right. So the idea of fundamental analysis actually goes back to our lecture 1, which is remember I mentioned about the credit analysis, where we use the ratios, we use various things like pastel and all those things, right? We mentioned a little bit about that, or like SWOT analysis. So doing the entire thing on the company is actually called fundamental analysis. Means that we will calculate what's the ratio of the company, we'll do like a comment on the balance sheet, P&L statement, etc. So that is called fundamental analysis. So what does it mean? It implies that fundamental analysis will not lead to abnormal return. Why? Because remember when we learn about fundamental analysis, we are using the annual report information, right? And annual report information are publicly available information. And so if the market is a semi-strong form efficiency, then your information from the annual reports shouldn't give you a kind of analysis that will allow you to gain more money, right? You wouldn't say that the stock is, let's say, undervalued and then you can buy the undervalued stock. You wouldn't tell you that, right? So that's why they say that fundamental analysis will not lead to abnormal returns. At the end of the day, it is still under an efficient market approach, right? So because remember, in the efficient market approach, there are 3 kinds of forms. We have the strong form, semi-strong, which we talk about, and now we'll go on to the third one, which is the weak form efficiency. So even though there's strong, semi-strong, and weak form, all of these 3 forms of efficiency all fall under the efficient market hypothesis, right? So that's important to take note that they are all considered part of the efficient market hypothesis. So it depends on which form of efficiency you think the market is in. All right, so for the weak form means that the price of the stock reflects all past market information. So the important part to take note is that only market information, right, and past, of course. That means in the past, right? And what is market information? So market information includes price and volume information. And so if you are familiar with like the Bloombergs, or even maybe not even Bloomberg, if you invest in stocks and you have the Mumu or the Tiger broker ad, right? Or sometimes even you see your parents, they might be observing certain charts and movement of the price. They might use this kind of chart, the candlestick chart. So all these are like price and volume information. So what does the weak form efficiency market says is that as an investor, if you just use all these charts and charts like this, you should not be able to earn abnormal returns, right? Simply based on trading information of the market. So when we use this kind of charts, the correct term to use is actually this thing called technical analysis. So when you're using charts, it's called a technical analysis, right? So we're just using the price and volume information. And it means that if you use these charts, we should not be able to earn abnormal returns here. But if you use fundamental analysis, we can actually earn abnormal returns under the weak form. So empirical evidence actually show that generally the market is under the weak form, meaning that if we do like a good analysis of the company, like what we learned in the first lecture on the ratio analysis and everything, we can actually earn abnormal returns based on our analysis done on the company. Right, so this is just a pictorial version. The weak form is the release is inside, and then public, and strong form includes public and private information. All right, so some common misconception of efficient market hypothesis that is very important is that efficient market hypothesis says that you cannot earn abnormal returns, right? I want to highlight the word abnormal. because it does not mean that you cannot earn returns. You can earn returns. So this is very important. So sometimes, questions can test your theoretical knowledge. Like, does efficient market hypothesis means that you cannot earn returns? Of course, most of the time questions will not ask you so directly. They give you a scenario, right? And give you a scenario that you need to be able to apply the scenario, apply this concept. So what's important to know is that efficient market hypothesis does not mean that you cannot earn money. You can earn money, but the amount of money or amount of returns you earn is only the market returns. So you can only earn market returns. You cannot earn excess or abnormal return. So it also means that on average, you will earn a return that is proportionate or appropriate of the risk taken. So it's a proportionate thing. And you cannot exploit any changes in price to kind of get excess returns. So the last point is important. Efficient market hypothesis actually does not protect you from your choice if you do not diversify. So Nick, after the break, we'll talk about this idea of diversification, but it's important to note that the efficient market hypothesis actually assume that you are a diversified investor, meaning that you hold many stocks. So this is an assumption that has to be made, right? So if you are, so let's say, today you feel like, oh, I've just gotten my bonus because March is usually April is the bonus month. Let's say you just got a bonus, and the thing is, you decide to invest in one stock. Let's say you want to invest in Meta, right? Facebook, Meta. If you're investing in one stock, the efficient market hypothesis will not protect you in the sense of saying that you will earn a market return, right? If that one stock or your Meta stock does a nosedive, or the stock price decrease, too bad, right? You lose your investment. So what does the efficient market hypothesis say is that the theory of efficient market hypothesis only stands or only makes sense if you are a diversified investor. May I just pause here? Do you have any questions? Because the concept of efficient market hypothesis is important to understand. Like, if you have any doubts, feel free to ask. So maybe we'll just take a quick, let's say 7 minutes break at this point in time. If you have any question regarding this theory, feel free to just put in a group chat during the break. All right, we'll come back in, let's say 7, 8, maybe 8:13. All right, welcome back. Hope you have a good break. Yeah. Okay, so before we continue, I guess there's no questions so far. So before we continue, right, I just want to highlight to all of you all that there are quite a few students that decide to drop from the course. So this will affect the your GBA groupings. At the moment, what I'm planning to do is for group 6 and group 7, so GBA group 6 and group 7, to merge, because group 6, I think you will only have 2 members, so it will be very tough to do the GBA. And there are a few more students that will be dropping off. So basically what I'll do is that I will repost the GBA groups on the notification on the blackboard on Canvas. So please look out. And at the same time also reach out to your group members to make sure that they are still part of the course, because sometimes they only inform like the school or even inform me much later, right? So if you know that they have already dropped out, do let me know. Yeah, so yeah, there's quite a few people that's dropping out. So please start reaching out to your group members to see whether they are still part of the course, right? And of course, if your team is 3, I think you can still do it, because there are a few groups that will have 3 members because of the people are dropping out. But if you have 2, then you should highlight me, because if it's 2 person, it'll be very tough to do it. All right. All right. Thanks. I think thanks for the reminder. So regarding your final exam and even your GBA submission, you can use, I want to highlight that you can use Excel to calculate or to show your workings. But I want to highlight to you that for Excel, if you are using any cell referencing, so what does this mean? Maybe I'll just pull out Excel to show you. Wow. Okay, so I'm just going to show you my Excel now. So for example, if I'm just doing like 1 plus 2, and then I have this 1 plus this cell here, right? In your GPA or your finals, if you use this thing called formula text, right? Which I like to use. This formula text basically gives you the formula of the cell. All right, and you notice that for this cell here, it is a reference, right? A cell reference. So in your submission, you can do a screenshot, right? You can do a screenshot. But when you do a screenshot, make sure you include the top row number, ABC, and 1, 2, 3. So if you are doing a screenshot, what you should be doing is this, right? You screenshot both the column and row number and alphabet, so that the marker will be able to know, oh, your reference of 1 plus B2, where is B2? So B2 is this one here. So that's how you do it. Any questions? Thanks for the reminder, Yan Ling. Thank you. Yeah, so we can use other kind of ways like show formula. That's fine too. Yeah, so you can use any other Excel method. But what's important is that you need to be able to, if you're doing cell referencing, you can do that, but you need to show where the referencing comes from. Especially, sometimes if your answers are slightly incorrect, then you can still get partial marks, right? But if the marker is unable to trace where your answers are from, he'll just give you 0. And as you know, like for like final exam, usually like for me, I will not be marking your paper, right? So other professors will be marking it. So you need to be very careful when you do this. So if they can't find your answer, they'll just give you a 0. So yeah, just be careful. And so, like I mentioned, for the GBA groups, after this lecture, I will post a notification to say the revised GBA groupings. But for those of you who know that there's no changes to your groups, then there'll be no changes. Only for those that there are more than 2 drop out, then I will have to combine groups. Okay. All right. So, and of course, if you have any issues, feel free to drop me an email regarding your grouping. Like people are not responding, you're not sure whether they are still part of the class, do drop me an email. All right. All right. So we have talked quite a bit on the risk and return. We talked about the theory. Now we will go even deeper on the understanding of risk and return. In particular, we'll talk about diversification here. All right. So remember earlier we just talked about mean. We talked about the arithmetic to geometric mean, right? And we mentioned about the thing on standard deviation and variance. Now, what we are going to think about, and it's even more pertinent or more important in finance, is this idea called expectation, all right, or expected mean. And whenever we think about expected, we need to think about the idea of probability now, because we know that, yes, the market might be doing well, right? It might be a booming at the moment, but what is the probability that the market will go into a recession? So because we know that when the market is in recession, the returns will be dramatically lower, right? So we need to be able to model, or we need to take, not really model, but we need to take into account the state of the various probability. So we normally use the idea of expectation, so expected returns. All right, and what does this bracket 1, bracket 2 means? It means that we need to first calculate this portion, then we calculate this portion. Meaning what? We calculate what's the probability times the return, then we take the summation of all the probability times return. So that's how we call it expected return. Don't worry, there is an example here. So the example is that we have stock A, B, we have the various return, we multiply it by the probability, and then we take a summation of it, right? In this way. So this is the working. So you see, you take probability, this is step 1, right? Step 1. And then after that, we take the summation here, right? Summation is step 2. Okay, so in terms of the variance and standard deviation, exactly the same, but the only part is that we need to account the probability. And again, I put 1, 2, and 3 here. 1, 2, and 3 is that first we need to do the part 1 first, this component here. Then we do part 2, which is we account for probability. Only on the last step, then we do the summation, right? Part 3. So this is an example of how we do it. So we have the expected returns here, right? So remember for standard deviation, we are taking the particular return minus the mean, right? Mean meaning the expected return. So you take 20. So how do we get this amount here? It is negative 20% minus 11.25, right? And then we take a square root of this. This is how we get the first value. So we are just inputting the various information inside. So expected return here is the mean, right? X bar, which is a mean. Okay. Then after that, remember that's step 1. Step 2 is to multiply by the probability. This is step 2. And step 3 is to take the summation, right? Here's the summation, which is step 3. Okay, so that is that's a short part on expectation. But what we have discussed a little so far is about this idea of portfolio. So remember I mentioned about S&P 500. So S&P 500 is a classic example of a portfolio of stocks, meaning there are many stocks in this one portfolio. All right. And when we have a portfolio, this will affect both the returns and the risk. So risk and returns, right? It will affect both sides. And there's some kind of trade-off, right? And we have a look at it. So first of all, let's understand how do we calculate the portfolio return. So now portfolio expected return. So now what's happening is that we have additional component, and this additional component is called W. If you flip back to the 3 or 4 slides ago, remember expected return was just P times R, right? Probability times R. But now we have one more component called W, which is the percentage of the portfolio invested in that asset. So this is how we calculate portfolio expected return. We have an example here, so don't worry. So these are the various value invested in asset A, B, C, D, E. These are the weights. So the weights, how we calculate weights, we just take 15K. So this one is just 15K divided by the total, which is 50, 200, right? That's how we get the weight of 30. So the question already gives you the expected returns. So remember how we calculate expected returns is probability multiplied by the returns, right? The average return, R bar. I'm just going to flip back to show you. So it's this one, right? Returns times probability times returns. So it's P times R. So in this question, they already give you what's P times R, so you don't have to calculate it. But what you have to do now is to multiply it by the weights given. And then step 4 is you sum it up together. So you sum all these values. Maybe I'll just pause here. Any questions regarding how we calculate portfolio expected returns? We are good. I guess no questions. Okay, so in the last example, remember the example already gives you what's expected return. So they already did the P times R for you. Now, in this question, this is the comprehensive example, like to put it. The idea, the comprehensive example is that now you're given probability, we are given the weight, we are given the various returns on the stocks as seen here. And so we are expected to calculate what's the expected returns. All right. So what do we need to do now? First, remember, so I want to flip back to the slide. So I want to highlight to you that you should follow what I mentioned here, the steps 1, 2, and 3. All right. So let's do step by step. Step 1. So step 1 is take the P times the stock price here. P times stock price, P times stock price. And then we should get this amount here, right? This is the ER, which is the expected returns, right? Remember, expectation is we consider probability. Now, once we have done that, we need to do step 2. Step 2 is taking what? So I'm going to use blue now. Step 2 is taking weight times the expected return. Weight times expected return. Weight times the expected return. That's step 2. Then what is step 3? Step 3 is the sum, right? We sum everything up and we should get 10% here. So it's a summation of everything. All right. So I want to highlight to you that if you follow these 3 steps here, step 1, step 2, and step 3, it should be relatively easy to follow, right? So always go by step. So don't do the weight first and all those, right? Don't jump steps. So 1, 2, 3, you should be good to go. Now, before we talk about portfolio risk, this is the part I want to highlight, that you notice for portfolio returns, what do? We simply just add up, right? We see it's just an addition, right? We just add up stock A, stock B, stock C, you just add everything up. We weight it by the W, right? And P for expected returns. And that's all. It's very simple. Now, what is tougher, or not tougher, but what is important is that in terms of variance and standard deviation of a portfolio, it is not equal, okay, I put a big not equal, to the summation of the various individual stocks, variance and standard deviation. All right, so I'll repeat one more time, this is important, is that the portfolio risk or portfolio variance or standard deviation is not the weighted average of the standard deviation of individual stock components. So it's not. All right. And that's because there is certain diversification that will happen, right? That we will look at. So there are certain kind of diversification that will happen, which will kind of reduce the risk of your portfolio without reducing the returns of your portfolio. That's the beauty of a portfolio. So a portfolio helps you reduce the risk without reducing the returns, and which is why everyone should actually hold a portfolio, right? Because you want, of course, as much returns but lesser risk. So let's not look at this. This might be a bit confusing. Usually I will skip this slide because I have a better example that I have provided. So I feel these two slides can confuse you quite a bit. So this is the classic example of how you do, or how you observe this idea of risk diversification and how it actually plays out. All right, so let's look at this example here. So imagine you have two stocks, all right, BB and SM. Okay, they give you the various returns for each year. All right, so again, before when we read question, we need to see, okay, they give me return already, so that's pretty good, right? They are not giving me stock price. All right, so that's good. They give you the composition of the various portfolio. So portfolio A will comprise of 25% of BB and 75% of SM. Portfolio B will comprise of 50% of BB and 50% of SM. So these are the various compositions. So the question is very simple. They ask you, what is the portfolio mean and standard deviation? All right, so first step, we do the mean first, right? So the mean is simply the average, the addition, right? You just add up. So how do we do it here? So we have two methods. Let's think about method one first. So for method one, what we do is that we will first calculate what is the, for each year. So for each year, right? So let's look at 2016 first, all right? For 2016, what is the portfolio return based on the percentage of BB and percentage of SM that you have? Okay, so those portion in red right here is the calculation provided here. But basically, you're supposed to calculate for everything, but I'm just showing you how you calculate those portion rates. So, for example, for portfolio A in 2016, we know that portfolio, okay, I'm just going to flip back. So we know that in portfolio A, we have 25% of BB and 75% of SM, right? So what do we do? Well, so we're looking at 2016 here. We just take this BB multiply by 25%. The SM of 8.23 multiplied by, 75% here. Can you see? So this is how we calculate the portfolio returns for portfolio A in 2016. So I'm just going to flip back. So that's how we got this value 4.6. Now, what we are supposed to do, we are supposed to calculate what is the average, right? Average portfolio return for portfolio A. So we have to repeat the calculations for 2017, 2018, 2019, 2020, and then we just take the simple average here, and we get the mean. So in this example, it's for 5 years. We add up all these values, and we find the mean. So we have to do the same for portfolio B, portfolio C. So in the first method, you notice what do we do? We consider each year individually, right? We do 2016, we do 2017, we do 2018, 2019, and then we just sum it up all together. Everyone's okay with this? Because there are two methods, so we need to really understand method 1, then we can understand method 2. Everyone's good? Yeah. Okay. All right. So that is method 1 for mean. Now, method 1 for standard deviation. So once we have calculated the returns for the year, right? Which is the same as this. So this, right? So once we are able to calculate the returns for a year, what do? We simply use the Excel formula standard deviation dot S. Remember, I say dot S because we need to consider the degrees of freedom of n minus 1, right? So if you use the one without the dot S, your answer will be wrong, and you will in your exams or what, you will get it wrong. All right. So please use dot S. Because you remove 1 degree of freedom, and you just use dot S and get standard deviation here. And it's pretty simple, right? Because we can do this for portfolio C and D. So actually, what is method 1 doing? So method 1 is doing this. Sorry, you are calculating what is the returns of the portfolio for each year, right? So for each year, so for year 2016, for portfolio A, you have 4.6. 2017 is negative 6.83, etc. So what do you do after you calculate the various returns for each portfolio? You basically almost as if plot it on a normal distribution, and then you use the standard deviation formula to calculate what is the standard deviation. And that's all. So in method 1, I would like to call it the statistical method. All right. So method 1 is the statistical method. So you use statistics to kind of get the value of the standard deviation. Now, everyone okay with the standard deviation, how we calculate standard deviation using the statistical method of method 1? Should be good, no questions. Now, let's look at method 2. So method 2, I would like to term it as the finance method. All right. So after you look at method 2, you let me know which one you prefer. All right. So in method 2, or AKA the finance method, what do we do here? So remember, we are given the question on the various returns of BB and SM. So let me just go back 2 slides and remove this. So for method 2, what are we doing now? We are going to first compute what is the mean returns for BB and mean returns of SM. After calculating the mean, then we multiply into the portfolio composition, right? So that's how we calculate the mean. So remember, it's a bit different from method 1. So now, so method 2, remember I said we calculate the mean. So we calculate the mean of this using the simple average, right? We're using simple average here. We calculate the mean to calculate simple average, as shown here. All right. And after that, we simply multiply it by the portfolio composition. So we take 6.16 times the portfolio composition of 25%, and then 3.88 times 75. Right? That's how we got this. So this is the finance method for mean. So the mean still more or less quite intuitive, right? Can everyone see the difference between method 1 and method 2 for the mean? Right? Method 2 is we consider the average of BB, average of SM. But for method 1, we were considering immediately the portfolio average for the individual years, right? We consider portfolio average for 16, portfolio average for 17, portfolio average of 18, all right? But now for method 2, we are considering the average of BB, average of SM, then we multiply it into the portfolio weight, 25%, 75%. Now, this is where method 2 becomes very different from method 1. Okay, so as usual, stop me if you are unsure, because this is important. This is one of the critical components to understand. So for method 2, how we calculate standard deviation is that recall that we have, wait, let me see, recall, okay. Recall that we were given that BB had these returns, right? SM had these returns. So these two were given a question here. We're given a question, right? So what do we do now? For method 2, we simply just take the standard deviation of BB, right? We're calculating standard deviation of BB, standard deviation of SM, using the standard deviation dot S formula. Now, this is the standard deviation of BB and standard deviation of SM, but it is not the portfolio standard deviation. Remember, because we still haven't considered the weight. We need to consider W, right? We need to consider W. It's a big star here. We need to consider W. So how do we consider W now? Now, method 2 being the finance method, we need to use this finance formula called W. Okay, so portfolio variance, the formula is W1 square, that means the weight of the portfolio, 1 square, multiplied by the variance, right? So remember, this is standard deviation, right? SD. If we square the SD is variance, right? So the variance plus the weight of number 2 square times variance of number 2. And we need to add this other thing called the covariance. So at the back here, there's this weird thing called, so there's at the back, there's this, not really weird, but like this additional thing called 2W1, W2, COV1, 2. So this COV is called covariance, all right, covariance. And what does covariance mean? Have anyone seen this term covariance in your statistics module? Okay, so presumably, I guess no. So covariance is the joint variability of two items, right? Covariance means the joint variability. So how the two items interact in terms of the variability. All right. Okay, so we need to, there's this additional formula 2 plus W1, 2 times W1, W2, covariance 1, 2. So the question is, how do we calculate covariance? Now, it is very easy because we have Excel. So we simply use the covariance.s formula in Excel, and we just plug in this entire chunk here. So we use the covariance.s formula and we highlight this entire box, right? We highlight these are the returns, right? These are returns given in the question. These are in the question. So they give you the covariance of this, and we just simply plug it into the formula, right? So for portfolio A, variance is given by, remember, W1 square, so the weight square, times the variance or standard deviation square. Remember this one we calculated in 2 slides ago. I'm just going to flip back. Recall we have calculated it here. Can you see? all right, plus W2 square variance of number 2 plus the 2 W1, W2 and covariance here. All right, and so this is the variance of portfolio, and hence to calculate standard deviation, and we know why we need to calculate standard deviation now because of the formulas, because we need it to be percentage, so we just do a square root, right, or the power of 0.5. Everyone understand how we do method 2 for portfolio standard deviation? So I want to highlight that we need to be able to do both methods. So unfortunately, you cannot say I only want to do method 1. You need to know both, because depending on the question, sometimes they will force you to do certain method. So we need to know how to do both method. Yeah. Okay, so if we are okay, then I want to tackle the last part here. You see this small little formula here. So this small little formula say that the correlation equals to covariance of the two object xy divided by the standard deviation. So this is a standard deviation of x times the standard deviation of y. So this is a formula that you need to know to find the correlation. So in Excel, what you can do is you can use the correlation formula. So CORR, if I'm not wrong, .S. So this correlation formula would actually give you the answer of correlation. And you can use the covariance formula that I showed you earlier, covariance.S, to calculate covariance. So maybe at this point of time, I want to highlight why do we need to use covariance, why we use correlation. So the thing is, remember, covariance is the joint variability, right? And we think about variability in terms of variance. And again, the issue with covariance is that there is a unit, and the unit is very difficult. It is a percentage square. So covariance from units is percentage square. So what we do when we use this formula here, is that we want to remove the percentage square. So that's why we divided it by percentage times percentage, right? Standard deviation is percentage, right? So because we divide by percentage times percentage, does your correlation have any units? So my question being, for correlation, are there any units for correlation? Yes, that's right. No. Very good. Yeah, thanks. So because you are divided by percentage square plus percentage square, there is no more units for correlation. So the correlation, CORR, is unitless. And we'll talk a lot about this correlation in just a bit, right? So yeah, correlation has no units, and it's a beautiful thing because we don't want any units. And what's important to take note is that your correlation is bounded by 1 and -1. So it must be more than -1, but it must be less than 1 because of this formula that we have seen here. Okay, so before I move on, right, we have seen two methods. The first method I say is the statistical method. The second method is the finance method. Why do I say that? If the finance method would make more sense to you, because just now we're talking about risk diversification, right? We are saying that, hey, you know what? If you have a portfolio, your risk would decrease, but your returns will not decrease. And you notice something, that we know that for portfolio variance, it's not the simple addition. right? I already mentioned it's not the simple addition of the various stocks, let's say stocks, standard deviation, right? It's not the simple addition because we have to consider the covariance part. Now, simply by looking at this formula here, the portfolio variance, would you prefer the covariance to be a positive number or a negative number? So question, simply by looking at the formula portfolio variance that I've explained, would you prefer your covariance to be a positive or negative number? Now, thanks for the reply, but do you notice, remember, portfolio variance, what does portfolio variance mean? Portfolio variance means the risk, right? Risk, the total risk. Remember, variance is the total risk, or actually standard deviation is total risk, but we just square root the variance is standard deviation, right? So variance shows you the total risk of the portfolio. Now, do you prefer more risk or less risk in this sense? Less, correct. We want to have less risk. So it means that if you want less risk, means that your covariance is, if your covariance is negative, is better, right? Because if it's negative, means that you're going to minus away, right? 2W, W1, W2 covariance, right? And so your total risk here would be lesser. So in this sense, right, that if we have a negative covariance or correlation, so remember both are the same, because covariance and correlation are being, in a sense, joined by this formula here, right? So if covariance here is negative, your correlation is automatically negative, right? So the thing is, if your covariance or correlation is negative, this would reduce your total risk of your portfolio and hence is very good for you. All right, so immediately we see the benefit of diversification. So what happens is that during diversification, your covariance would be less than 0. So in this example here, can you see that your covariance is 0.0000365? And so because of that, there is some diversification that's happening, meaning that you reduce the reduce the risk without reducing the returns. So this is the benefit of diversification. So method 2 very easily, because of the formula, shows you the concept of diversification in the formula. All right, so I'm just going to flip back to method 1. Can you see that method 1? So this is how we calculate method 1. The answers are exactly the same. So I highlight answers are exactly the same. The thing is, in method 1, we are unable to see the concept of diversification happening, right? Because this is just a statistical method, but both methods give you a correct answer. So I just want to highlight that method 1 has the power, has additional power in the sense that it can show you the variability from the idea of diversification. Hence, method 2 is the finance method. Okay, so I strongly encourage you to practice this question here. So I strongly encourage you to practice this question using Excel to make sure that you are able to get the answers that I have provided to you, and try to use the Excel formulas. Why? Because in your finals or even in your GBA, if you are being asked to calculate this portfolio mean, standard deviation, you should be able to use the various Excel formulas to calculate. So I strongly encourage you to practice this example on your own. All right. Okay. So those were quite a bit heavy in terms of calculation, but they're important concepts. So the idea now is that whenever we make an announcement, right, there is a surprise component and an expected component. Right, the surprise component is the component that will affect the stock price, right? It's a surprise to you, right? So it affects the stock price. And the thing is, this surprise component, when it affects the stock price, remember we talked about the efficient market, right? The market will either immediately go up like this, or sometimes it will take a bit of time, right? You'll go like this, or it might be overcorrect like this, right? Go like a pyramid, go up and down, or triangle, not a pyramid. So the thing is, as the market try to incorporate the information as fast as possible, the faster it can incorporate information, the more efficient the market, right? Remember we mentioned that if the increase is immediate like this is a super efficient market, right? It's an efficient market. But if it goes up like this, it's not so efficient. If it goes slowly up, it's not so efficient as well. So if it goes up immediately, it becomes an efficient market. But the thing is that in order for it to incorporate surprise information, there must be some inefficiency in the market in the first place, right? Because if the market is, remember, the strong form of efficiency, then the all information should be incorporated. There is no surprise information. Everything is incorporated, right? So if everything is incorporated, then the stock price will not increase. So do you understand? So that, can you see the almost like a circular argument is that you need the inefficiency in the market so that it might be like a semi-strong form or weak form market, so that there will be surprise information, and therefore the market can incorporate this information into its stock price. And the faster it incorporates information, the more efficient it becomes. But if it becomes super efficient and incorporates all information, then it will become a strong form market. And when it's a strong form market, there's nothing more to incorporate, and therefore it will not be efficient. So it's like a circular argument here, right? So I hope everyone can appreciate this kind of circular argument that's happening. Maybe you have a question of, why is it important, right? So, sometimes application question can come in a form of like this, right? Like asking you, actually, how does this circular argument of an efficient market works? And so you need to be able to explain this. Everyone able to explain? So yeah, that's right. That's right. If the market is super efficient, the share price will not go up. Why? Because if it's super efficient, the market will be a strong form. So we are linking back to efficient market hypothesis. So if the market is super efficient, you'll be strong form. And strong form means what? You only hold a diversified portfolio. You cannot earn excess returns. There is the price will just reflect market returns, and market returns are kind of stable, right? Like it just goes following the market. So yeah. All right. So we have talked about quite a bit of returns. Now we want to separate returns into two components. Total returns equals to expected returns plus unexpected returns. All right. So expected returns is, of course, what you expect. Now, in terms of unexpected returns, this is where it becomes a bit interesting, because we want to segregate this into two components here. We want to segregate into systematic and unsystematic. Okay, so this is very important. You will definitely need to be able to differentiate what's the meaning of systematic and unsystematic component. All right, so in this sense, the total returns equals to expected plus systematic plus unsystematic. Now, the question is, what is systematic? What is unsystematic? What does this mean? Okay, so let's explain here. So, systematic risk. So, systematic risk, basically, the most important part is that is non-diversifiable risk. So, it's in red here. Meaning what? It means that if you have a portfolio, you will not be able to remove this amount of risk. So, regardless of how many assets or securities or stocks you put in your portfolio will not be able to remove this systematic risk, right? And what is this systematic risk? So systematic risk, you can think about it almost like a market risk, and it means that it is external to the portfolio. So things that will impact a portfolio, but you are not in your control, right? So it can be inflation, it can be GDP change, interest rate. So these are all risks that are present, but you cannot control for them, right? Because they are, you just can't control for it, right? It's you might be a company, but you can't control GDP. So these are systematic risks that is non-diversifiable. Now, unsystematic risks are the ones that can be diversified away by elimination and putting many assets in a portfolio. So how does this unsystematic component work? And okay, so the example given here is parts shortage, labor strike. Anyone kind of know how does this unsystematic risk is being diversified away? Anyone can explain, but before I explain. No? Okay, so maybe this is like the first time you have seen this word unsystematic risk. Okay, so let me explain to you. So unsystematic risk is the risk that is diversifiable away by using a portfolio or putting more and more asset in the portfolio, right? And so the risk will just so-called disappear. Yeah, it literally disappear. And so how does it disappear? And why is the example labor strikes and part shortage? So how I like to explain this is so that you can understand and you just don't memorize this, right? So for example, in your portfolio, you have a stock on utilities, let's say utilities, and you have another stock on oil and and maybe supermarket. So utilities and supermarket, right? So maybe in Singapore it's not so I don't know, maybe can. Like during COVID, right? You have a shortage of, let's say, supermarket products. All right. But in terms of utilities, the shortage of supermarket products does not affect the utilities company, right? It only affects the supermarket company in your portfolio. So by putting more and more stocks that are from a diversified portfolio that is not, I guess, supermarket, can you see that the risk of the shortage of food that's affecting supermarket stocks only is being reduced, right, by the presence of other types of stock like utility stocks. And so that is why this kind of, that's why the example of labor strikes, part shortage are considered unsystematic risk. All right, that is kind of almost unique and asset specific. And so because it's so specific to asset, by simply considering other types of stock in your portfolio, you would remove the risk or the unsystematic risk. Okay, I'll just pause here. Any questions before we continue? So I want to highlight that it's important to understand the differentiation of both. All right. So now, going back to the idea of diversification. So we have learned two kinds of systematic and asystematic. So when we add more and more stocks in our portfolio, what happens is that we will only reduce the unsystematic risk, but the systematic risk would forever be there. And what does this mean? It means that at the end of the day, the risk that is present in a diversified portfolio is a systematic component, and we are only being rewarded by the systematic risk. So, now it's like almost like a full circle moment for this lecture. In a sense, remember at the start of the lecture, I mentioned like, oh, you know what? The more risk you take, the more rewards you get, right? But I mentioned that, oh, but you need to be careful. The type of risk matters. And so this is like a full circle moment in the sense that now we have learned systematic risk and unsystematic risk. And so it means that you are only going to be rewarded by taking on systematic risk. So if you are going to take on unsystematic risk, you will not be rewarded for more returns. What does this mean? It means that, for example, today I got my bonus, right? And then I want to buy a stock. If I have two choices, I buy S&P 500, which is a diversified portfolio, or I buy Meta. If I'm going to buy Meta, I'm going to take on the systematic risk and unsystematic risk of Meta. And in this sense, right, the returns on buying Meta will only compensate me for the systematic component because I'm expected to diversify, right? The market is not going to compensate me for the unsystematic component of risk that I'm taking. So, but of course, if I buy S&P 500, I'm only taking on systematic risk portion, as all the unsystematic risk is being diversified away by holding a portfolio of 500 stocks. All right. So the idea of diversification can be seen in method 2 of our calculation, when we talk about the covariance or correlation, right? And we remember we talked about correlation formula equals to covariance divided by standard deviation of 1, standard deviation of 2, covariance 1, 2. All right. So in the classic form, I have kind of already insinuate to this part where if the correlation is negative, it will result in risk diversification. So basically anything less than 1 will result in risk diversification where the risk is kind of removed. And what risk is being removed is only the unsystematic risk that's being removed, right, by diversification. So the systematic component will always remain. So, which is why actually I suggest method 2 as the more important method to understand. Although I must say you should be able to understand both methods, but method 2 is more important because we are able to actually see in terms of the formula, the correlation component, which will impact the risk diversification, and in particular, the diversification of the unsystematic risk. All right. So this is just an example of the various stocks. All right. And I would like to show you this part here. So I'll jump back to the slide that I just skipped. So the thing is, can you see the number of stocks in the portfolio? This is the standard deviation. Remember, standard deviation measures the total risk. Total risk. So the thing is, can you see as the number of stocks continue, what happened? The systematic risk remains the same, right? This is systematic, SYM. Systematic risk remains the same. But the unsystematic risk kind of decreases, right, with diversification. So this is the perfect example of the idea of correlation that remove the unsystematic risk. And so what happens, okay, so I'm going to jump back to the slide, is that for a fully diversified portfolio, what we only have is the systematic risk component. And on average, we see that around the 40 stocks, the unsystematic risk is fully diversified away. There's no more unsystematic risk. All right, so this is just a repeat slide, just to drill in the concept is that total risk equals to systematic plus unsystematic plus the, remember, expected return, here a bit missing. Okay, and remember, total risk is measured by standard deviation in a well-diversified portfolio. Whatever that is being remained is actually only the systematic component, as the unsystematic is fully diversified away. SYM is fully diversified away. So in terms of the risk principle, there is rewards of bearing risk, like we mentioned, but there is no rewards for bearing unnecessary risk. And the idea of unnecessary risk is the unsystematic risk. So if you're going to bear unsystematic risk, you will not be rewarded. The only rewards you get is by bearing systematic risk. Okay. Okay, so before we go to the idea of this beta, maybe we'll just take another quick, let's say 7 minutes break. We'll come back at 9:17. And as usual, if you have any questions, feel free to write in the group chat. Hello, welcome back. How's everybody? Um, how's everyone surviving so far? Is it very heavy or so far okay? Yeah, a bit heavy. Okay, yeah. Um, yeah. Unfortunately for this lecture 4 and lecture 5, it's a bit heavy. Yeah. Um, but don't worry, try to read through the slides after the lecture. You should, and of course, you have any questions, feel free to email me. But you should get better to read your slides. So when you see it for the first time, it can be a bit heavy. So, okay. So let's try and push on a little more. So we, before we had the small break, we were talking about total risk, right? I'm just going to flip back that total risk is measured by standard deviation. Now, the thing is that for the systematic risk, there is a special measure called beta, right? So beta measures the systematic risk. And of course, this whenever we measure beta, it has to be in a diversified portfolio, means that there is the unsystematic component is all gone, right? It's all diversified away. And the beta basically measures the systematic risk, which is like things, remember the kind of risk like GDP, inflation, so those things that affect the market, right? So we know total risk is measured by standard deviation. Just a quick question. What kind of security has zero total risk? Anyone can remember at the start of our lecture? So the question is, what type of security has no risk, theoretically? Remember this thing called risk-free? Which one is it? Bonds, treasury bill. Yeah, I see that. Yeah, so treasury bills are kind of like bonds, but they are special bonds, which is given by the government, right? It's like not even the government, but like the treasury of the government. So treasury bills, perfect. And this we say that has zero, right? Okay, why is this important? So let's look at it. Now, if we think about it in terms of beta, which measures the systematic risk, on average, all stocks should have beta of 1. All right, so on average, all stocks should have beta of 1. This is the market beta. So this is important, called market beta is 1. So in questions, there can be questions where they just simply say the market beta. No, so they don't even tell you the market beta. They just say the beta of the market. They don't even say that. Maybe they just say whatever beta, and then the market, they just leave market beta. They don't even mention it, right? So what I'm trying to say is that you need to know a few key so-called beta or key standard deviation kind of thing, where in terms of beta, market beta is always 1, all right? And just now we mentioned that for T-bills, T-bills is a risk-free. There is the standard deviation is 0. So in the same sense, if we think about it in the form of a fully diversified portfolio where there's only systematic risk, for T-bill, the beta is 0. So these two are the key things that you remember. So market beta is 1. T-bill, beta is 0. All right. So before we go very in-depth into beta, right, I want us to remind you, what is beta? So sometimes, right, when we really go very in-depth into understanding finance, or as we progress further in this module, sometimes we can get a bit confused. Like, So we talk about beta, 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 but what is it? Is it some like abstract concept? Is it something that is like, or pluck out of thin air? So the of course answer is no. So I don't like how I like to understand things like this, like very abstract, like beta, is to put in context what it means, right? So remember, at the end of the day, beta is just systematic risk. And what is systematic risk? Systematic risk is like inflation risk, it is like GDP risk. So try to bring in context what it means, right? So once you understand what it means that if the beta is more than one, the stock is more risky, right? So there is more systematic risk. Now, if it's less than one, it is less risky than market. All right, so that's how you can understand. Because later we'll think about beta, we'll talk about various formulas with beta, and then after a while we're like, okay, so what's beta again? So try to remind yourself, beta is just the systematic risk of a stock in a diversified portfolio where there is no more unsystematic risk. All right. So the good thing about beta is that in a portfolio, what can we do? We can just simply do a weighted average of the beta. So for example, we have 30%, 40%, and maybe what's this? 30%, right? Of various stocks. And the beta can be 1, 1.2, and 1, 0.8. So we just simply just take the weighted average. So beta is, in a sense, additive. And because additive means you can just add up all the values to find the portfolio beta. All right. So the question here, we have two securities. We have the standard deviation and the beta. Now the question is, which security has more risk? Anyone can try to type the answer. Which one has more total risk? Security C or security K? Which one has more total risk? So this one, which has more total risk? All right, thank you. That's right, because higher standard deviation, right? So remember, total risk is measured by standard deviation. The next question, which one has more systematic risk? Okay. C, that's right, C, because of the beta. Now, which security should have higher expected returns? Okay, okay, hopefully, okay. So I see K. Now this is the part that is tricky. So it's actually, answer is actually C. Okay, why? Remember, at the end of the day, you are not being rewarded by taking on more risk, right? Remember, I talked about a full circle moment where at the start of the lecture, I say, oh, more risk, more return, right? Like as a finance student, you know, more risk, more return. But then I told you that, hey, but wait, we need to consider the type of risk. So when we consider risk, we are actually only rewarded. Remember just a few slides ago, we are only rewarded for bearing risk that is necessary, but there is no reward in bearing unnecessary risk. What does this mean? It means that we should be only rewarded by bearing beta risk or systematic risk. If we are bearing unsystematic risk, we will not be rewarded. So let me just go back to the question. Can you see that security K, because the standard deviation is so high and the beta is low, it means that actually security K has a lot of unsystematic risk. And so we should not be rewarded by bearing unsystematic risk because it's unnecessary. All right. But we should only be rewarded by bearing systematic risk, which is beta, which is why when the question says which security should have higher returns, that is security C, because we are only rewarded by bearing systematic risk or beta risk. All right, so this is an important question. This is a very conceptual kind of question. All right, but thanks for trying. All right, so next we look at this idea of risk premium and beta. So in terms of risk premium, again, this is a full circle moment in a sense. At the start of the lecture, we talk about risk premium, right? And then I told you, oh, it's very simple. You just take the returns of, let's say, in that case was a bond or stock minus the treasury bill, right? Which is the same thing, because treasury bill is the RF, right? Risk free. So risk premium is just what's the expected return minus the RF. So the higher the beta, there'll be higher risk premium. Okay, why? Remember, that's where you need to know what's beta. Remember, I say beta can be very abstract. Like after talking so much, you don't even know what's beta already. Remember, simply by thinking, beta is the systematic risk, right? So if you have a higher beta, means higher systematic risk, means that of course the risk premium is higher, right? Because you're taking on more risk that cannot be diversified away, right? So hope this makes sense, right? So higher beta, higher unsystematic risk, and therefore higher risk premium, right? So it makes sense. And so we can actually define a relationship between beta and expected returns. All right, okay. So we have this graph here. If I want to highlight that this graph is important, and it's actually very important in the sense that in the exam, they will not ask you plot the graph or something like this. But it's very important in terms of understanding, because even in the later chapters, we'll go back to this SML line or security market line graph. And it actually explains a lot. All right. So hope you can really understand how we even plot this graph. But rest assured, you will not be asked in the exam to plot a graph. Okay, so let me try to explain to you this graph here. And of course, if you have any questions, please clarify your doubts on this graph. Okay, so this graph we start with the axis, right? So the x-axis is the asset beta. The y-axis is the asset expected returns. All right. Okay. So we know, remember 2 points that I say is very important in terms of beta, and that they are the risk-free beta, risk-free one, and the market beta, right? And market beta is 1. Remember, I'm just going to flip back to the slides. Remember this one? We say there are the 2 important parts. So I'm going to plot these 2 points on the graph first. Okay. So in the graph, the risk-free is 0, right? So when beta is 0, which is here, this is the risk-free, right? Which is the intercept. Now, I'm going to plot a second point, which is the market beta at 1. And this is the rate here. ERM means the expected market return, right? So market beta give you market return. Anyone can remember what is the equation of a straight line? What is the equation of a straight line? What's the equation of a line? Do you know what's the equation? Probably this is at secondary school, if you can remember what's the equation of the line. Perfect. That's right. Y equals to mx plus c. So now that we are given 2 points, we know the risk-free at 0, which is the intercept at C, right? And we know the market beta of 1 will give you the market returns. Can we actually construct M, right? M is the gradient, right? M is gradient. And what's gradient? Gradient equals to Y minus risk-free, right? Y1 minus Y2 divided by X1. So what's X1? Minus 0. Can everyone understand this? So I repeat again, understanding the graph is very important, but we will never be asked to plot. But we need to understand the components of the graph. All right. So M is the gradient, which is given by this. And what does this equate to? This equates simply to the gradient is this, right? Expected market returns minus RF, which is actually given here. All right. Okay, so how do we do the equation of the line now? Y. Okay, so equation of line. So now I want to find the equation of the line here. So what's the equation of line? Equation of line is Y, right? Y, which is expected Ri, right? Y is here, equals to M. What's M? E Rm minus Rf. Mx. What's X? X is beta, right? So multiply by beta I plus C. What's C? The intercept here, Rf. So this is the equation of the line. And this equation of the line is actually written here. Can you see here? This is the equation of the line. And this equation of the line has a special name. It's called the CAPM model. So in the subsequent slides, we will define the CAPM model, but this is the CAPM model here that is given. Now, there are a few important characteristics of the CAPM model, and if I were you, I'll write them down or put a star. Maybe you can't put a star, but you should write them down. In the sense that there are a few assumptions that you need to be careful of when you use the CAPM model, which we'll go in detail in just a few slides. Because the CAPM model is being derived from the security market line or SML, it means that, okay, I'm just going to erase this out. It means that we need to assume a fully diversified portfolio that is only bearing systematic risk, because it means that the security would fall on the gradient given by this. All right. So, for example, if you are calculating the expected returns, right? Expected returns using the SML line, using an undiversified portfolio means that you get one stock. This is actually incorrect. You cannot use the CAPM model to calculate, because when we formulated the CAPM model, we are using the equation Y equals mx plus c, and how we can actually use this is because it's an equation of a line, and then it is actually a fully diversified returns. So this is important to take note. And what it means is that all security, so this is quite, I would say, counterintuitive in the sense that all securities in a diversified portfolio would be on the line. So all securities will fall on this line here. Now, of course, we know that based on efficient market hypothesis, the market is a weak form or semi-strong form. Means what? Sometimes we might be able to find, using fundamental analysis, security that is above the line. Can you see when it's above the line, what happens? You notice that for the risk taken, so can you see the line is here? And if you find a security that's here, for the beta risk, which is a systematic risk taken at this point here, the security that you found that is giving this return here is actually higher than the expected returns that you should get based on the security market line. And this excess return is given by alpha, A-L-P, alpha, all right, alpha or this. So this component here, or alpha, is the abnormal returns that we have been talking about when we're discussing the efficient market hypothesis. So this is the alpha. And remember, in the efficient market hypothesis, we cannot get alpha. We cannot get abnormal return. We always only get market returns. And therefore, all our securities should all fall on the line here, right? It cannot be above the line. Maybe I'll pause here. Any questions regarding this security market line? Like I say, it's important to understand the various components of the line. What does it mean? The underlying assumptions. What does the alpha? How does alpha appear, etc. Okay, so now, so what happens is that based on the security market line, SML, remember we calculated the gradient M. So gradient M, right, actually gives you the risk and reward ratio or trainer ratio. So what does this mean? It means that, remember earlier we used the market beta, which is 1. But let's say we do not want to use the market beta, right? We want to use, I'm just going to flip back. Let's say if you just want to use a random point here, right? Random point B, let's say BJ, right? So this random point BJ will give you a return of ERJ, right? It's just a random point. So in this sense, right, we can actually formulate the risk and return ratio, right, where ERJ minus RF divided by beta J. So this ratio here is simply the gradient of the graph, gradient of the security market line. So generally, a higher risk to reward ratio, the better, right? That means you're getting more return per unit risk. And what kind of risk? Per unit systematic risk that you're taking. All right, so this is the market equilibrium assumption. Like I mentioned, that it must be fully diversified, the asset must be in equilibrium, right, in order to use the SML line. So what is this trying to say? Remember, your beta of the market is 1, and therefore this cancels out and you just get this part here. So this is the CAPM model. So this is a repeat. It says that the security market line represents a market equilibrium or security. So this is important. All securities fall exactly on the security market line. Remember, I say that anything that's above is the alpha returns, but that is not efficient market anymore. And if you notice, the slope is actually equals to the market risk premium. Now, there is a few additional interesting ideas of the security market line. And you can see here, so a change in the risk characteristics means what? That means a change in data. Remember, risk characteristics of individuals are systematic risk. So systematic risk is measured by data. And if you change the beta, obviously, you will move along the line, right? So beta, and beta. So you move along the line. So you increase or you decrease. Now, a change in attitude of the investors towards risk. This will affect the risk premium. And what does it mean? Remember, just now we proved that the gradient of the line equals to the risk premium, which equals to this thing here. Means what? If there is a change in attitude, means that the line gradient might increase or decrease. So there is a change in the gradient, maybe steeper or less steep. The last but not least, a change in market conditions, such as inflation. What does this mean? When there's a change in market conditions like inflation, your RF would change, right? Your risk-free would change. Because remember, your risk-free is measured by your treasury bill, and your treasury bill, actually, remember at the start of the lecture, I said, would be somewhat equals to your inflation rate, right? And then we saw how it was quite similar, right? Inflation or inflate. So what happens is now that if there is a change in the capital market conditions, there will be actually a parallel shift in the security market line. All right. Okay, so we have kind of defined the CAPM model. And so I want to repeat again, the CAPM model is derived from the security market line, and it is given by this, right? So it looks scary, right? It's given by this. It looks scary, but we have already kind of proved it and showed you that it's simply derived from the formula Y equals mx plus c, right? So this is basically a formal introduction of this, where RF is the risk-free rate, which is given by T-bills or T-bonds. The risk RM is the market risk premium. So this, sorry, not market risk, market return. Okay, this is important, but this is market return. Now, RMP is market risk premium, which is given by expected market return minus RF. So I want you to be very careful with this. I'll put 2 stars here, simply because you need to read the question very, very carefully. Are they giving you market risk premium, or are they giving you market return? So there are 2 formulas here. If you give you market risk premium, use this. Market returns is this one. Okay. So please be very careful, because this is, I think, like the last few times, like during finals or GBA, not really, because it's a good work, so somebody might spot it, but like in your finals, sometimes they can be very tricky. They say like the market risk premium is this, and then you do minus the risk-free rate, then your whole answer is wrong, right? So be very careful. I'll just put another star here. So read the question carefully. So once you find the market returns, you know the risk-free rate, you can calculate what's the expected return on asset using the CAPM model. I want to repeat here again, just in case you didn't catch it earlier, that when we are using the CAPM model, we necessarily have to assume many assumptions. And one of the assumptions, or one of few assumptions that is important to consider, is that we are holding a diversified portfolio. There's no unsystematic risk. The securities are all in equilibrium, and all the securities fall on the security market line, right? So those are very important conditions, because we know that based on efficient market hypothesis, this might not be the case, right? We might be a case of a semi-strong or weak form market where there are inefficiencies in the market. So a lot of times we use the CAPM model without really understanding the assumptions, and therefore in real life actually it doesn't really apply, right? But we still use it nevertheless. So this is highlighted here again. CAPM model compensates investor assuming beta risk, only the systematic, because we are assuming a fully diversified portfolio. All right. So in this question, what's happening here? We are given what is the expected return, all right? And then we can use CAPM model to calculate what is the required return, because we are given these two, right? And we are given beta. And when we compare required with expected, we see that the required is 13, okay, for stock A is 13.4, but the expected is 14. Means what? Means that stock A is actually undervalued. And similarly for stock B is overvalued, right? This is another repeat. Before we move on to the last problem or last workout solutions, do we have any questions regarding this CAPM model? How to apply it, how to use it, components of it? So I want to repeat here that expected market return, sometimes they can say, oh, the what is it? Okay, for risk-free, they can say the T-bill, they can say T-bill rate of return is, let's say, 5%. So if they say T-bill, you should sure we know is the risk-free, right? And this one, they can say the market return, right? Market return is something, I don't know, market return maybe is 8%. So we need to be able to know the any questions? Okay, we are good. All right. So if we are good, I think there's two questions, like so-called quick quiz. We are given the beta of this, risk-free is this, market is this. What is the risk and return ratio? We just plug in the formula of market minus risk-free divided by beta. All right. What is expected return? We use the CAPM model to calculate what's this. All right. Important that they give you market return, so it's not market risk premium. So we need to minus away the risk-free rate. All right. Okay, we have another question here. This one needs a bit more like equation. So we see that we have $1,000 invested in 3 stocks, A, B, which are the same amount, and C, right? So how much will you invest in stock C, given that you have the required returns and the market return? So if you expect to have a return higher than market return, right? So what does this mean? It means that we need to now, first of all, find what is the weight of C. So you know what? I'm just going to jump to my note so it's easier to write it. So you have the question in front of you. So what's happening here? So let weight of A and B be W, right? So we know that for A is W, B is W, and C is simply 1000 minus 2W. All right. So what do we do now? we can do the equate, we can equate the weight multiplied by the returns, right? So let me just jump back to the slides here. So we have the expected returns. So what we can do is now we just equate the weight times the returns. So W times wait, for A is what? Let me see. A is 1%, 2%, 4%. Okay. So plus 1% plus weight times 2% plus 1000 minus 2W times 4%. All right. So this should be equals to the market return, right? Because they say that must be higher than the market. So it must be equals to 3.5%. Sorry, I'm just jumping between. All right. So we should do this, and then we solve for, so solve for W. And once we find W, we just take 1000 minus 2W, we should get weight of C that we need. I'm just going back to the slides. Don't worry if you couldn't copy that formula, because actually it's all given here, right? But this is just written in like statements. Sometimes it's very hard to understand. All right, so this is the last example we have. And basically it concludes today's lecture. Any comments? Questions? Anything? So maybe as you think about it, I just want to repeat again. Please check your GBA groupings, because there are quite a bit of movement this term. I will be posting a notification on the revised grouping once I remove and merge some groups. But of course, if your group is unaffected, you know that all your members are still doing the module, then you don't have to worry, you can continue with your GBA. I'll post it by today so that you can kickstart your assignment. And of course, if you have any issues with your grouping, you can't find a member, he or she is not replying, do reach out to me, right? So maybe, I know today, if your member do not reply after reaching out to him or her, do reach out to me. Maybe he has withdrew from the course, so yeah. But please click a look at the notification later today. I'll post the revised grouping, right, so that you can see your groups. So anyway, thank you. It's a bit late for you. I think it's almost 10 p.m. So thanks for coming for the lecture. As usual, if you do have any questions, feel free to email me, or like in the next lecture at the start, we can answer any questions that you have. All right, yeah, have a good night. It's actually it's just the start of the day for me. It's 10 a.m. I'm 12 hours behind you. So yeah, good night to you. I'll kickstart my day. Hope you enjoy the lecture so far. All right, thank you. Thank you. Have a good night.